The VT Gravis Clean Energy Income Fund was launched in December 2017 and seeks to provide exposure to the clean energy sector by investing in a portfolio of listed infrastructure companies that are engaged in the provision of low carbon and renewable energy. The scope of the mandate is global, although the significant majority of companies held within the fund are listed in Canada, the US, continental Europe, and the UK. This is very much an income-focused strategy, with a key objective being to deliver an annual net yield of 4.5% or more. Over time, we hope to grow capital and increase income distributions. From a top-down perspective, the fund is clearly quite thematic in nature. It is, however, unconstrained in terms of allocations towards underlying energy generation types, although wind and solar assets typically dominate owing to them being the most widely deployed. Geographic exposures are not constrained, although we do focus on companies listed in OECD nations. So we maintain a portfolio that is diversified by energy generation type and that is geographically diverse. There can be benefits from geographic diversification owing to changes in weather patterns in different regions, affecting the performance of the energy infrastructure assets that we are exposed to. We focus on gaining exposure to companies that own and operate cash-generative, contracted assets. So that is to say, a large part of expected power output from the energy generation assets is contracted through power purchase agreements or supported by government subsidies, which provides good visibility over revenues and underpins dividend distributions. The fund has a clear income target of 4.5%, and so this is, of course, a major consideration as part of portfolio construction. We are long-term investors and expect to hold positions in the portfolio for a long time. So whilst the fund is actively managed, it is not aggressive in terms of stock turnover. On the face of it, the portfolio is high conviction and concentrated with around 30 holdings as a typical level. However, investors should take comfort in the large number of underlying energy infrastructure projects to which the underlying companies are exposed. At present, we estimate well in excess of 2,500. So the portfolio is more diversified than one might think. Exposure is spread across a range of geographies and energy generation types, which brings additional market diversification and mitigates regulatory risks, while a spread of exposure to different climates and weather systems, which is evidently useful when considering the fund is exposed to assets whose performance is sensitive to wind speeds or irradiation or hydrology levels, for example. Listed infrastructure companies often benefit from long-dated contractual revenues, and the primary return element is often via income distribution. This results in an element of duration risk. So that is to say that movements in reference government bond yields can impact the present value of assets and their relative attractiveness within capital markets. This is partially mitigated by an element of indexation or inflation linkage within underlying revenue streams. The fund's mandate is geared towards renewable and low-carbon energy infrastructure projects. It is managed in accordance with a responsible investment statement which prohibits exposure to some forms of energy generation assets such as coal, oil, nuclear. With regards to governance best practice, the fund votes systematically in accordance with ISS sustainability recommendations. Investors will often use the fund as an alternative income exposure, as an alternative to traditional fixed income exposures, or even physical property. The thematic focus of the fund also tends to lend itself to investors who incorporate environmental considerations within their portfolio construction, for example. The revenues generated by the underlying companies in the portfolio are in the main uncorrelated with cyclical trends. In addition, the energy transition represents, in our view, a multi-decade structural dynamic that may continue to see investment through economic cycles. As such, and similarly to the broader global infrastructure sector, the fund may be viewed as having the potential to offer safe harbour in economic downturns.